This is question number 2 on homework 10 for module 13 on the discounted cash flow model. So this is a question about given the financial statements and a bunch of assumptions about sales growth, NOPM and NOAT, we are asked to figure out some of the inputs which are necessary to use the DCF model to estimate the stock price per share. So following are the income statement and the balance sheet for Intel Corporation. And there's a footnote here says that which refers to these gains, losses on equity method investments net. So this should be considered as operating income. And this will be useful when we calculate the NOPAT, because NOPAT is based on we'll need to know operating income, and then we'll adjust for the taxes on the operating income to get the net operating profit after taxes. And the balance sheet also has a footnote, which is about other long-term investments. Here it says these investments are operating assets as they relate to associated companies. So this will be useful when we calculate the net operating asset, because in order to do this calculation, we need to categorize the items on the balance sheet into the operation related and non-operation related. So in order to do this, let me first copy the financial statements into my Excel sheet. All right, so paste the special by text. That's the way I prefer to do this copying, and also the balance sheet. So when make the copying, notice here, what I do want to do is to make sure that they are left aligned. The reason for me to do that is because I want to make sure that a year matches across the income statement and balance sheet. This may not be useful for this specific question, but just keeping that as a habit, which might be useful under some cases. All right, so the first part of the question is asking us to compute net operating assets. So we know that net operating asset is operating assets minus operating liabilities. So in order to do this calculation, we just need to categorize the balance sheet into the items on the balance sheet into the operation related and non-operation related. So let's do that one by one. Cash is not operation related, and short-term investments, this is investment related. So it's also not operation related. And trading assets, I believe that's also investment related. Accounts receivable, that's operation related. And so is inventories, deferred tax assets, and other current assets. And net PPE, that's also operation related. But marketable equity securities is not operation related. This is also a investment related. Other long-term investments, and as we just read the notes, this is also a operation related assets based on the footnote. And goodwill is operation related. Other long-term assets generally we also assume this is operation related. So we're done with the asset side, and liability side, short-term debt is financing related. So this is also not operation related. Accounts payable is operation related, and accrued compensation and benefits, operation related. Accrued advertising, operation related. Deferred income on shipments to distributors, also operation related. Other accrued liabilities, operation related. So long-term income taxes payable, this is also operation related. But long-term debt is not, because this is financing related. long-term deferred tax liabilities, this is also operation related. And other long-term liabilities, this is operation related. So we're done with the asset and the liability side of the balance sheet. So based on that, we can calculate our NOA. Basically, this is the sum of the total operation related assets, which is this one, plus accounts receivable, plus inventory, and plus deferred tax assets, and plus other current assets, and plus net PPE, and plus other long-term investments, and plus goodwill, and finally other long-term assets. So this is the sum of all the operation-related assets, and then we subtract the sum of all operation-related liabilities. So accounts payable and accrued compensation and benefits and accrued liabilities and plus deferred income on shipments to distributors and other accrued liabilities and long-term income taxes payable and long-term deferred tax liabilities and other long-term liabilities. So then close that, and then I guess we are done with this NOA calculation. So this only asks us to calculate NOA for the for 2010. So we just we don't have to drag the cell to the other year to get the corresponding number for another year. So basically, we just copy the number. Part B, compute net operating profit after tax, assuming a federal state statutory tax rate of 37%. Hint, gains and losses on equity method investments are considered operating income. Round your answer to the nearest whole number. So if we check the lecture slides for module 3, we can find that the formula to get the NOP80 is NOPBT, net operating profit before tax minus tax on operating profit. And further, tax on operating profit equals tax expense and plus pre-tax net non-operating expense times statutory tax rate. So we start from NOPBT. That's why here I put the NOPBT here. So this is basically the operation-related income. So it's operating income. But in this case, if we look at the note, it also says we should incorporate gains, losses on equity method investments, because this is also part of the operating income. So we need to add these gains on equity method investments. And pre-tax NNE, so this is basically the expense items which are not operation related. So in this case, it's basically all the items below this gains on equity method investments. And notice here, it doesn't say interest expense, and this number is positive. So this means that on average, actually, the firm earned interest income. So because we are interested in, we're trying to get an expense number, so we should take all these values, either the gains or the interest, to be negative amount, to be consistent with that this is an expense item, which means that if it's an expense, then this is positive. And because this formula here assumes these numbers, expense are positive numbers. Otherwise, it cannot be a tax shield. So now we can apply that formula to get the NOPAT. So NOPAT is NOPBT, and then minus the tax, right? Tax on operating profit. And tax on operating profit is further equal to provision for taxes, which is the tax expense, and then plus this pre-tax NNE, and then times the statutory tax rate, 37%. So now we should also use following the rounding requirement. I guess it's better to simply use round function. It's not better. We need to use this because if you look at the setup, it says that we need to use use your rounded answers for subsequent calculations. So we need, which means that we should use round function throughout this problem. So NOPAT, we can copy the number back now. This is basically the answer. And then part C is trying to use the so-called parsimonious forecast method to forecast the firm's cash flows. So we need to do the sales forecast, and for the sales forecast, we need to generate two types of numbers. One is to round to 2 decimal places, another one is to round to the nearest number, and then we need to get the NOPAT and NOA. And why do we do that? Because if you check the formula for the FCFF, which is the free cash flow to the firm, that is NOPAT minus the increase in NOA. Once we know the NOPAT and the NOA for each year, we can further figure out the FCFF. So, and that's why here I generated, I also basically copied all this information, including the terminal sales growth, which is somewhere, I guess here. Yes, it's assuming that the terminal period growth rate is 1%, which is different from the 10% sales growth rate for the horizon period. And horizon period numbers are copied here. So now sales. Sales, obviously, the current sales is directly given, right? We can just copy the number here. And then the next period sales is basically the current sales times 1 plus the sales growth rate. But for the sales growth rate, I do want to fix the sale value, because otherwise, when later on when I drag the sale to the other years, this will by default, this will also change. But I don't want that to happen. So I just basically do this, and then I need to use the round function to the 0 decimal place. And I guess this is because I didn't format sales to keep the 0 decimal place. All right, so now if I simply drag the sale to the other years, and the other year's number will automatically populate it. And then the terminal period basically is simply the last horizon period sales times 1 plus this terminal sales growth rate. Again, I want to fix this, even though this may not required, but just as a habit. So again, I want to round to 0 decimal place. Actually, I think I did that for. I should have done this for the second row here, because the second row here is basically is to this I will need to round to two decimal places. The current sales is simply just copy the current number, and then this next year's sales is simply the current sales times 1 plus the sales growth rate. And I want to fix the sale here, because later on I want to drag the sale to the other years, and I don't want this to change. And here, because it asks us to round to 2 decimal places, so I need to keep that rounding requirement. And also this is because I format sales, I just kept 0 decimal place. So I changed the format to keep 2 decimal places. And now I can drag the cell to the other years, except for the terminal period. And for the terminal period, it's the last horizon period sales, and then times 1 plus this terminal sales growth rate. So this is already just kept 2 decimal places. And now the second sales number is just trying to keep 0 decimal place for the sales we already got. So I just use the round function and then pull the sale to all the other years, including the terminal period. And for these values, I want to make them left aligned. I guess for all these numbers, just easy of viewing. NOPAT, so we are given the NOPM, net operating profit margin. We know that net operating profit margin is defined to be NOPAT divided by sales. So given the sales and given the NOPM, we can get the NOPAT for each year by simply multiplying the sales by this net operating profit margin. But for the current year sale NOPAT, that's automatically already calculated. We just use what we have here. And the same is true for NOA. NOA is simply the current year's number, is what we already calculated. So I just use that number here. And for NOPAT, as we said, this we can calculate based on the sales times this NOPM. But for NOPM, I want to fix the sale. So, and here I want to keep 0, also use the round function, keep 0 decimal place. So now I can pull the sale to the other years. All right, so NOA can be similarly calculated based on the NOAT, net operating asset turnover. So this is defined to be sales divided by NOA. And once we know sales, we know NOAT, we can figure out the NOA by dividing the sales by the NOAT. So this year's this number NOA is simply the sales divided by the NOAT. For NOAT, I want to fix the sale value and also use the round function to round this to 0 decimal place. So I can also pull all the sale to the latest year. So we are done with this, and the rest of the job is simply to copy the number back to this table. All right, I'm done with copying all these numbers back to MBC. So part D, estimate the value of a share of Intel common stock using the discounted cash flow model as of this date. Assume a discount rate of 11%. Common shares outstanding of 5,511 million and net non-operating obligations of negative amount, 21,178. So this is negative because the firm has net non-operating investments. So use your rounded answers for subsequent calculations. That's what I did throughout. Round all answers to the nearest whole number. Round discount factors to 5 decimal places and round stock price per share to 2 decimal places. And use a negative sign with your NO answer. So to get this, going back to my Excel sheet, here basically I just copied the cost of capital. And first step to figure out the FCFF is to calculate the increase in NOA. We have the NOA numbers throughout all the years, so this can be easily done by taking the difference between the current period NOA and last period NOA. And then here, because all these numbers are already integer numbers, we can just, we don't have to use the round function. And FCFF now can be calculated going back to the formula is simply NOPAT minus the increase in NOA. So this is NOPAT minus the increase in NOA. And then pull the cell, drag the cell to all other years. Discount factor is basically 1 divided by 1 plus the oh, I forgot to put equals plus 1 over 1 plus this weighted average cost of capital. And for the first year, I can just stop here, and this will give me the correct answer, except that I need to use the round function, right? Round function and keep 5 decimal places. But I do not want to make some manipulations on the power of this denominator here. For the first year, the power on the denominator is 1. That's why I don't have to write anything. But once I change this to be raised to the power of the year number and then minus the current year number. And the reason I want to do that is because later on I want to close that first. Later on, I want to drag the cell to the other years in order to automatically populate the cells. But I do want to fix the current year. So the only thing I want to change is the year number. So the power will automatically change. And this B29, I also want to fix that because I don't want the discount rate to change. And so I guess that's what I want, basically. Now I can drag the cell to the other years. You can see this will automatically calculated. So present value of the horizon FCFF basically is by multiplying the FCFF by this discount factor, by the corresponding discount factor. And then don't forget to use the round function. Round this to 0 decimal place. And then drag the cell to the other years. And then the cumulative present value of the horizon, FCFF, is simply the sum up all these present values. There are 4 present values in the horizon period. So simply sum up is 4 values. And present value of the terminal FCFF. This is calculated by first, we want to get the present value in terms of the last horizon period. This we can use the present value of a growing perpetuity, which equals the FCFF of the terminal period divided by the RW minus the growth rate in the terminal period. So far, the value we calculated is the present value of this growing perpetuity of the terminal period. Remember, terminal period goes into the infinite future, right? It's not just this one number. The reason we just use this one number is because this can be calculated based on the formula here. But all other numbers can be calculated based on the growth rate, right? Sales growth rate. But then because we are ultimately interested in the present value in terms of the true current, which is 2010, so we also need to discount this present value in terms of the last horizon period back to the true present, which is by discount this by 1 plus the discount factor and then raised to the power of 2014 minus 2010, which is 4. But I can also use the year number minus the difference between the year number. And then don't forget to use the round function. All right, so the firm value basically is the sum of these two, right? It's sum of these two. And the N and O is a negative number first, And going back to the setup, it's negative 21,178. 21,178. So now, because we're going to subtract a negative number from firm value, so the equity value will be larger than the firm value. So the equity value is going to be firm value minus a negative NNO. So shares is given by 5511, right? 5511. So ultimately, price per share, because by doing this calculation, we have made sure that equity value and shares, their units match, and both units are in millions of units. Equity value is in millions of dollars, and shares are millions of shares. So once we divide these two, we don't have to worry about giving the worrying about the unit for the price per share, and that will automatically be dealt with. So that equals equity value divided by shares, and then use the round function. And remember, the setup asks us to round this to 2 decimal places. So that's what we are doing. So I think we are done with this part of the question. The rest of the job is to copy the numbers back. All right, so I'm done with copying the numbers back. The last part of this question, Inter stock closed at $22.14 on this date. So our estimated stock price turns out to be larger than this one. This means that we believe the stock is undervalued, right? How does your valuation estimate compare with its closing price? What do you believe are some reasons for the difference? What investment decision is suggested from the results? Our stock price estimate is higher than the INTC market price, indicating that we believe the stock is undervalued. And that's true. Our low stock price estimate, and obviously this is not true, right? Stock prices are a function of expected NOPAT and NOA, as well as the WACC discount rate. And this is true because if you look at the discounted cash flow model, firm value is, hence the equity value also is the present value of the expected free cash flows of the firm. And further, its free cash flow is depends on NOPAT and NOA. And the present value here depends on the discount rate. So ultimately, the stock price is a function of the expected NOPAT and NOA as well as the discount rate. So this is our high stock price estimate may be due to more optimistic forecasts or lower discount rate compared to other investors and analyst model assumptions. And this also is true because any estimate depends on assumptions. So the reason we get a higher intrinsic value of the stock compared with the actual price might be driven by our more optimistic assumptions. And those optimistic assumptions may be both due to a higher cash flow or a lower discount rate, right? Both will drive a higher intrinsic value. So this is true. So now let's check our answer. So you can see that marks for this submission is 55 out of 55, which means we got every part of this question correct.